Where do the wealthy people put their money? What do they do with it? What is a portfolio? And how do I build one? What's the difference between being an investor and being a trader? What tools do they use? What are brokerage accounts? How do I buy stocks? If I buy a stock, does that make me a business owner? Do I own part of that company? These are some of the questions that we're going to answer in PSA 1, The System, Part 2, Brokerage Accounts. The information in this video is not intended to be financial advice. This is a thought-provoking video meant for entertainment purposes only. Make sure you contact a certified financial advisor and enter a contract with someone you trust before making any financial decisions. I don't invest. I just put my money in every 2 weeks and hope that they know what they're doing. End quote. Everyone. That is what everybody who I speak to about investing or about the banking system or about anything to do with derivative wealth has to say. Claim that they don't invest, yet they put a large amount of capital into the stock market in a passive environment. What I mean by passive, when you put your money into an account and the person who's managing that account has full reign and you have absolutely no idea what they're doing with it. Then when you look at that second level of what they actually are doing with it, they aren't investing wisely because this new generation of managers, of brokers, they are passive investors. And what I mean by that, they invest in what they're told to invest. They aren't investing based on the rules of investment, which we are going to discuss in this section. There are certain rules that investors have followed over time, such as don't buy things that are overvalued, don't buy into a bubble. Common sense things. Unfortunately, the common sense is starting to disappear in this generation. And as a result, there is a huge amount of cash flow going into sectors that it should not be, historically speaking. And as a result, we are now on a runaway train of passive investing. It's like the tail is wagging the dog. If you want more information on this particular topic of passive investing, I would highly encourage you to look up Mike Green. He's the economic genius who brought this to my attention. Everybody is sleepwalking, passive investing. They are not taking charge of their finances. They're not looking at capital flow. They're not looking at sectors. They're not even looking at the reason why. They're simply buying because they're told to. And this is a generational problem that we have to stop. One of the contributing factors to this passive investing environment is also the educational system. They teach the financial advisors to act this way. It's not their fault. So how do you know if your investor or your advisor is a passive investor? If you've ever heard him say something along the lines of, it's not about timing the market, it's about time in the market. If you just stay in the S&P long, no matter what, you're gonna make money. If the investment strategy is to simply hope that the Fed continues to add liquidity to the market, this runaway train, hoping for higher and more inflation, because that's essentially what's happening, increasing rise in the price of assets artificially. If they make these statements, if large portion of your portfolio is invested into the FANG stock, what I mean by FANG stocks are these. If you're in the MAG 7s, if you're completely ignoring the fact that the VIX is sitting at a 20 handle right now, and you're still in the FANG stocks, it might be time to find a new manager. It might be time to change your perspective from passive to active investing. So how do we do that? I'm glad you asked. It starts with self-education and taking ownership of your finances. And I know you have other things to do. Fights on Saturday night are way more important than this. We have to decide what we want to do with our time. Some of the top points of education, in my opinion, who I have found, is number one, George Gammon's Rebel Capitalist Pro. They have Q&A sessions to where you can literally pick their brains. And this is not an infomercial for Gammon. I'm just saying this is how I fine-tuned my thesis, is by bouncing my ideas and learning in these Q&A sessions from the pros who actually know what they're talking about. So that's one area. Another one, big picture trading. Patrick Seresna's. Other notable educators include Chris McIntosh, Lynn Alden, and Dr. Anas Al-Haji, Alhaji. He is one of the top on the oil sector, which I'm going to get into here shortly. So let's talk about the 10 rules of investing. Number one, markets tend to return to the mean over time. Number two, excess in one direction will lead to an excess in the opposite direction. Good to know. Number three, there are no new eras. Excesses are never permanent. Think of how similar the current market resembles the dot-com bubble. Exponentially rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. We're going to talk later about the drop and what the drop looks like. I have been waiting for this market to correct since October of last year. This is almost a year later and it's still rising. I was just a little early in my prediction. Number 5, the public buys the most at the top and least at the bottom. An example of this is when I was at a restaurant recently, speaking to the bartender, and she told me that the stock in the company of the business, it was a major chain, was doing really good. I pulled it up and looked, and it looked just like the chart for the S&P. And she saw it at the top and said, "Ooh, I need to buy that." And I had to remind her, buying things while they're very expensive is the way we emotionally feel. But is it the correct move? Is that what we should be? Shouldn't we be buying at the bottom, not at the top? Shouldn't we be educated on this? Number 6, fear and greed are stronger than long-term resolve. Remember to watch the VIX. The VIX is the fear and greed index of the market. This right here is the VIX. The VIX is holding at now it's holding at 21.33. This is an extremely volatile market, and the VIX tells you exactly how volatile it is. Number 7, markets are strongest when they are broad and weakest when they are narrow to a handful of blue chip names. Isn't it interesting that a major contributor to the entire S&P 500 consists of 7 stocks, and they are magnificent according to what everybody believes? Number 8, bear markets have 3 stages. This is one to remember: sharp down, reflexive rebound, and drawn out fundamental downtrend. It's a triple stop. It's a 1 bounce, 2 bounce, 3. It's a 3-step drop, and it looks like it might be coming. Look for yourself. Number 9, when all of the experts and forecasters agree, something else is going to happen. And last but not least, bull markets are more fun than bear markets, unless you have put protections on those bear markets. Those are the 10 rules of investing. And I believe that if you invest without knowing the rules, then you are a guppy in a pool full of sharks. So now you've educated yourself. You understand that you have to take the bull by the horns, and you're ready to. What's the next step? Evaluating what's in your accounts. How much money do you have in your various accounts? After you've determined your total amount, now it's time to allocate a certain percentage to each different area of your portfolio to establish a portfolio. So what percentages go where? 10% of your portfolio, your total derivative wealth, should go to sort of an insurance policy. That insurance policy could be physical gold. I also believe that Bitcoin falls into that category, something that's outside of the system but also inside the system. The next category would be the 80%, and that, by definition, should be something that pays you to own it. A variety of different things. The last 10% of your portfolio should go to your speculation. What do you think is going to give you the most asymmetry for the leverage, the amount of cash that you have to allocate to that 10%? In my opinion, I have found options that can multiply the cash via leverage for my return on investment. I will break that down for you when we get to that section. It's not as complicated as it sounds. So the 10% portion of your portfolio that goes to gold or stable Bitcoin, it doesn't really need its own slide, does it? Physical gold, or if you can't purchase it because there's nowhere to store it, you could supplement that by going to the Sprott Physical Gold Fund. That's something that you could do. I'm not going to linger too long on gold. There's so many resources and references out there that you can find. So for that 80% of your portfolio that is supposed to pay you to own it, that can be anything. That could be turnkey real estate. That could be bonds. That could be stocks. That could be whatever it is that you want it to be. You have to come up with your thesis. My thesis, and the thesis of the person who I got this from, is that it might be a volatile market, so it might be time to go safe. What is the safest asset that you can purchase, historically speaking? That would be treasury bonds or treasury. That is by definition the safest form, the most root form of fiat currency, which is government-backed currency, because a treasury bill or a treasury bond is direct debt. The government owes you that amount because they issued you that bond or that bill in return for the payment on that bond. It is safer than the safest savings account because you cut the bank out of being in the middle of it. Therefore, you get the whole reward of what right now is, let's look and see. Let's see what the interest rates are right now for a treasury bill. So a 3-month treasury bill right now will yield you 5.1%. Is that more than your bank is offering you for your savings account? This is a way to go. This is somewhere where you can go with that 80% of that. I'm not going to take the time to educate you on exactly how to set up a T-bill ladder, but I can give you the basics. You decide what time frame you want your treasury bills to expire, and you purchase them in increments on expiration date, so that as a third of your investment expires, then you can repurchase new ones, and they keep having a staggered expiration date. That's essentially what a T-bill ladder is, and I would highly encourage you to look that up and figure it out if that's something that you're interested in doing for a short-term safety in a volatile market. Again, the more you educate yourself on these topics, the easier they become. Education equals the confidence that you need. You're just a couple steps away right now. So let's say after you've evaluated these things and you've learned from Lynn Alden and Chris McIntosh on sectors and stocks and how to invest and how to do these things, you have to trust yourself at a certain point to execute. But you don't execute until you know that you've educated yourself to the maximum that you have time for. Now it's time to create your thesis. The thesis starts with the needs, hierarchy of needs. What does the world need? Who makes it? How does it get to me? And what is the economic conditions of that market? So here's an example. Part of my thesis is that it takes a lot of energy to get the stuff that we need. Specifically, if we have disruptions in the supply chain, specifically if we have debasement of currencies, specifically if we have wartime environment, I believe that the oil and gas sector might be worth looking into. So how would you look into the oil sector? You would look at the subsector. You look at the supply chain and find out which corporations assist in getting that oil from inside the ground, from under the ocean, into your gas tank or into your furnace. You look at what is upstream, midstream, downstream, and you start looking at each sector. By now, you've already studied Lynn's work, so you know how to evaluate the value of a stock, of a company. So then you start creating a watch list. So yes, it can be a tedious task and it takes a little bit of work. This is one picture of me after taking several pages of notes and whittling down my list and narrowing down which companies I wanted to own stake in based on all of the different dimensions that I had. But as you can see, it takes a little bit of work to come up with your own ideas of what you like. And this was one of the lists that I made earlier this year as a result of my studies. And you have to do the same thing. You have to look and see a company's value. As an example to what I mean by the asymmetry of the value of a stock, if you look at the S&P, it's currently pretty high, relatively speaking, to the rest of the time, and I can't believe it's down to 540. I need to take a look at that. It had a big drop today, and I haven't even had a chance to look today because I've been doing this, but interesting to see that. So if you look at the value of the S&P overall on the chart, it looks kind of high. If you look at one of these, let me give you a good example. So if you look at Tidewater, for example, this is in the oil sector, which obviously we've had a pretty long down cycle in the oil sector. If you look at all of the companies, it's been highly valued and now it's devalued, and it's made it through all these years. So to me, I look at a company like this, one of many, and I think to myself, well, oil has a pretty bright future, especially after I've educated myself on this particular sector. This is just one example of oil. You're going to have to do the same thing for natty gas, for thermal coal, for power grid electrical, healthcare, movement, transport, chemicals, steels, any commodity producer that you find interesting that seems to be inexpensive, relatively speaking. It's worth breaking down by subsector and educating yourself and creating a watch list to see which stocks you do want to own when the time is right to purchase them. So let's talk about the speculative side of your portfolio, the fun part. Not gamble, but seek asymmetry with or invest. And you have 10% to do it. My particular favorite way to use my speculative portion of my portfolio is to exercise options. Have you ever heard of stock options before? Have you ever asked what they are? An option is a contract through a brokerage account between you and another person who you never meet. And that contract is either a right or an obligation to buy or sell a certain amount of stocks, usually 100 shares, of that security at a specific price for a specific time frame, okay? The call option is the right to buy. The put option is the right to sell. There's so much information on this and it's so overcomplicated. However, big picture trading is by far one of the best learning tools that I've found to understand options and to use them wisely in my portfolio. So to give an example of an option, think of an insurance policy. Your insurance policy. It is a contract between you and your insurance carrier. It is the obligation of the insurance carrier to purchase your vehicle based on a number of different specifications and your specifications for an established time frame, which would be like a 6-month policy. Does that sound like a call or like a put option to you? If you were to say it's a put option, you are correct. And why would the insurance company want to issue a put option on your vehicle? It's for the premium. It's for the income. You are giving them cash for that time frame, and they are hoping that you don't call them on that option by getting involved in a total collision, an accident that they're going to have to pay for, or that it gets, whatever. Essentially, an insurance policy on your vehicle acts exactly the same as a put option would act on your portfolio. Can you see why, if one were to believe that it's a volatile market and one were to get an insurance policy on that portfolio, one could feel a sense of ease, especially when they see what they have been predicting for a while start to take place. So at this point, you may have realized that there's a chance that you are a passive investor. What do? Become active. Become active. Become an active investor, okay? Take a look at all of the possibilities in that restrictive account that you have and find out which fund most matches your thesis and what you believe. You can allocate your funds and your resources where you want. A couple small examples, and I'm not telling you what to do. But if you believed that treasury bills were the safest form of currency that you could hold, well, you might be able to find a fund within that account, within one of your brokerage accounts, that has money market or treasuries or something along that line. Find something that's safe within your options. Or let's say there's a commodity producing fund, some sort of an energy fund. You could wait until the dip and then buy it when you feel that that's the appropriate time to do it. You do have some options and you can take control, is what I'm saying. Just don't sit back and say that it's overwhelming, because you can understand this and you can do it. You really can take control of your finances. It's doable. So what's the difference between a trader and an investor? Well, really the only difference between a trader and an investor are the timeline of when you're planning to execute this investment and the tools that you use to execute them. That's essentially the difference. Are you going long? Are you going short? Are you playing it safe for the long haul? Are you getting into the water and swimming with the current? This is the difference between a trader and an investor. What is a brokerage account? Brokerage account is simply an online medium where you can exercise whatever tool you have gravitated to through your education to exercise your thesis, seeking the asymmetry that you're looking for, evaluating your own risk versus reward, and hopefully enjoying the reward of that risk that you took. Again, education is key, because education gives you the confidence. Once you have the confidence, then you can go forth and conquer. And there are several options for brokerage accounts. Top 3 that I use are Interactive Brokers, Fidelity, and Schwab. So by now you're starting to feel confident. You're starting to understand how the financial system works and what your role is in order to get ahead of the cash flow to find wealth like wealthy people do. This is why money makes money. But what I offer is the truth. And sometimes the truth does hurt because there's a little bit of pain involved. So let's talk about who regulates the brokers, protects me. First of all, there is 0 reserve requirements by the brokerage accounts to hold any of your money. Therefore, they do loan it out at they call margins. Margins are where they take your dollar and they leverage it out as a loan for other investors and traders to use to multiply their dollar. The actual number of leveraged derivatives out there in the various brokerage accounts is actually unknown. No one can even guess how much money is leveraged out in the derivative play. However, there is an insurance policy. They offer $500,000 in insurance for securities, for equities, and $250,000 in cash. So you're safe. Think of the SIPC as you would think of the FDIC for a bank account. You're safe, right? Until you start looking at the reserve ratio. And that reserve ratio, I used artificial intelligence to find the closest number, and the closest I could get is 3%, and I don't even trust that. You could find the reserve ratio for the SIPC on the total amount of insured securities Please tell me, because that is a number that my brain can't even compute. And finally, do I own my stocks? If I buy these stocks, do I own them? Do I have a piece of that company? Well, unfortunately, the answer is no. Primary ownership of the stocks go to the primary brokers. Those primary brokers, I'm going to get into the who on part 4, but the Depository Trust Commission is the main owner of all equities that are publicly traded. They then source it out through secondary brokers. That sourcing is conducted by the DTCC. You're going to have to look that up or wait for part 4, the who. And the DTCC then allows the secondary brokers, Interactive Brokers, Fidelity, Schwab, to transact and apply all these margin leverage. And that's where our money is sitting. And if there was some sort of a crack in the system, unfortunately, again, you would get a residual claim on assets. I'm sorry to be the one to have to tell you this, but this is true. So if you don't actually own any of the ones and zeros on any account, on any screen, on any phone, if you don't actually own them, then it's not a bad idea to have some insurance, perhaps some physical gold, perhaps some Bitcoin that's not in that system, perhaps some physical cash or some survival needs that you may or may not have. Think of the real world. Another consideration would be purchasing some sort of a turnkey residential home in a different country. The passport, not a bad idea to consider these things. If you cannot leave the country, maybe consider rural living if that's something that would fit your needs. Easy to say, hard to do. I'm living in a main city and I don't see any chance of me leaving within the next couple months. So I'm in the same boat with you. I'm just saying these are considerations and things that I've thought about and have considered a contingency plan for. So where do wealthy people put their money? What do they do with it? We know that they build a portfolio by allocating all of their derivative wealth into different areas that they break down by percentage. We broke down bonds, we broke down stocks, we broke down options. We did not cover futures, we did not cover currencies, we didn't cover day trading because it's just something that I just haven't educated myself enough into to explain. We talked about the difference between an investor and a trader and how it's essentially the timeline of their execution of their strategy and the tools that they use. We talked about brokerage accounts and how they're essentially an online medium that you use to exercise your thesis that you've developed through your education, using the tools that you've gravitated towards through your education as well, that being stocks, options, bonds, whatever. We discussed how the brokerage accounts have 0 reserve requirements, just like the banks. We talked about how the SIPC regulates brokerage accounts and that the reserve ratio is unknown. And finally, we discussed the residual claim on property that you own. This has been PSA 1, the system, part 2, brokerage accounts. I would encourage you to stick around and see part 3, the macros, where we break down the macroeconomic environment that we see unraveling before us. After part 3, that will conclude the first half of the system. If you want to take a look at who is behind this, what their plans are that they've openly stated, why they're doing it, and most importantly, how to actually protect yourself and your family from the system that we see is directly in front of us at every angle. In PSA 1, the system, part 2, brokerage accounts.